This is APC's version of the Boston Tea Party. And all you out there that don't want to pay a penny more in taxes than you're required to by law are obviously hardcore, like we are. And none better than my friend, the friend of the firm, Sara Knight, that will be leading our time together tonight. And Sara is a CPA and has been certified in the state of Tennessee since 1994. After working with Arthur Anderson, which was then, I think, one of the big eights.
It was the biggest firm at the time.
Okay, biggest firm at the time, and McMurray and Company, and they're friends of ours. They're a local firm, and they've been around a long time. She opened her own practice in 2001, and her specialty is in individual, small business, nonprofit accounting, and taxation. And Sara, how long have you been with asset planning?
I started working with asset planning when I moved back to Knoxville in 1996.
So she has a long history with the firm, with Paul, his dad, with me now, and she's a trusted partner for our firm and for me personally and my wife. She is married to Tim Knight and has two wonderful adult children. She was born in Maryland, but has lived in East Tennessee for most of her life. She enjoys volunteering with her church, cooking and gardening in her free time, which is very little. And she also enjoys her time at the beach. And one of the questions we asked her was, who is her favorite client of all time? And shockingly, she answered APC. And who is the favorite person that she has ever worked with? And she said, Joe. So that's very flattering, Sara. I sure appreciate those kind words and vote of confidence. And with that, we're going to ask you to help us save in taxes.
Oh, Joe, you crack me up every single time. I do love working with asset planning. It's funny, my parents actually were invested in one of Kemp's partnerships. I remember I was very young, relatively new when I started working with asset planning. And I have always remembered that Paul Fain had his kids' drawings hanging from the ceiling fan in his office. And he was someone to look to as you kept your profession and your family and your faith in the forefront. And Joe, I think you do the same thing. So working with asset planning and with you and Paul really have been great parts of my career. I want to thank you, Asset Planning, for having me, but all of you for being here. I hope tonight's informative and helpful as you maybe not begin, but hopefully are continuing to plan for 2022. Kind of have divided my part of tonight into three pieces. The unchanged items that I just think are important to remember as we continue to plan. Also, some somewhat new information, some guidance that has changed a little bit in the last couple of years. And then also the Inflation Reduction Act was passed this past August, and that has some impact on our 2022 tax returns that I want to touch base on. To start with these unchanged items that are still important, the first one I want to talk about is charitable gifts from your traditional IRA. For several years, if you are 70 and a half or older, you could make a gift from your IRA to a charitable organization, and that distribution would be tax exempt and qualify also towards your qualified minimum distribution. So that is still in effect now, even though the age for a qualified minimum distribution has increased from 70 and a half to 72. You can still make these charitable gifts from your IRA and it be tax exempt beginning at age 70 and a half. A couple keys to remember with these transfers, with these charitable gifts, is one, it has to be a trustee to trustee transfer, which means, for example, if your IRA is held by Schwab, Schwab must write the check directly to your charitable organization. It can be mailed to you and you deliver it to them, but it must be written directly to that nonprofit and not to you. Another thing to remember is that nonprofit has to be a qualified 501c organization. So just make sure that your nonprofit does qualify for that. You know, a lot of the small local fire departments and things like that have not gone to the steps to become a qualified 501c3. So make sure that organization does qualify. Another reason that this is important, we're going to talk a little bit about the standard deduction on your tax return. A couple years ago, it almost doubled. And when it did that, a lot of people were no longer able to itemize. It was more beneficial for them to go ahead and take that standard deduction. When this changed, this made these charitable gifts not being taxable even more valuable to those of you who are 70 and a half or older, because that was a way, if you're a charitable person, to do that and have that income excluded from your taxable income. Also, along with that increase, a lot less of us have been able to itemize since that change in the standard deduction. So what happened was the standard deduction for married filing joint return went from $12,500, $600. You know, that changes for inflation each year. For 2022, it's 25,900. So it doubled pretty much. So a lot of us no longer itemize. And when that took place, a practice of bunching has started taking place. Now, what that is if you're close to itemizing, but not quite each year, what some people have started doing, and I think asset planning has advised on this as well, is to think about your itemized deductions and those that you have control over, try to group them every other year. So if you're thinking about doing this, if it's something that might work for you, first thing you have to do is kind of know what those itemized deductions are. So itemized deductions are made up of deductible medical expenses, real estate taxes, your mortgage interest, state income tax if you file a state income tax return. And even though you live in the state of Tennessee, you may file a state income tax return due because of the source of some of your income. And you can either take that state income tax or sales tax. And then, of course, charitable giving. Those are the most common. There are a few others. And the ones that we have the most control over are our real estate taxes and our charitable giving. To make it easier to understand, think about, for myself, maybe I realize I'm not able to itemize in 2022. So while my real estate taxes are due anytime between December of 2022 and February of 2023, I may wait and pay those real estate taxes in January or February of 2023. And then next year, I'm thinking about bunching my itemized deductions. I'm going to go ahead and pay those 2023 real estate taxes in December. That way I have 2 years of real estate taxes in 2023. That's doubling my chance so far of itemizing. With a similar thought, yeah, I don't want to harm the nonprofits that normally I give to, that I'm charitable with. So the way my husband and I have started doing that is through 2023, we'll give the same way we normally would, but then come October, November, December, we'll start looking ahead to 2024 of the things we plan to give or we know we'll give during the year, and we'll go ahead and give those in 2023. That increases our giving in 2023. So that makes it far more likely that we'll itemize in 2023. We still won't be able to in 2024, but it still benefits us every other year. So that's the practice of bunching your itemized deductions. Some other things that could play into that is medical. Most of the time we don't get to plan when we have a medical surgery or stay in the hospital, but something, most of the time you do have time to make payments on those stays. And so if there is a stay in 2022, maybe you hold off making those payments till January or February on that stay. So that's the idea of bunching. Another thought when you're trying to tax plan for 2022 is consider a Roth IRA conversion. Some of the time when I recommend this, you may look. Most of my clients, and most of you all are thinking about that this time of the year, and you're saying, okay, it looks like most of my income, I'm usually in the 24% bracket, and I have maybe a $10,000 cushion before I make that big jump. That next tax bracket is 32%. So that's a jump we try to avoid I mean, I'd rather make the money and pay tax. I say that often. However, if I can keep us in the 24% bracket, I will. So say we have a good $10,000 cushion, you may want to take some traditional IRA and do a Roth conversion. When you do that, what you're actually doing is accelerating the tax. So you're paying the tax on that traditional IRA in 2022, but now instead of being a traditional IRA, it's a Roth IRA, and it grows tax-free for all the future years. So in a year where you have some cushion in a lower tax bracket, that's a good tax plan to think about, and that's something that asset planning can help you with if you're looking at that. Another thing that most of my clients tend to do at the end of the year, October, November, and December, you really, if you have an investment account, you need to sit down or make a phone call to your advisor and talk about the status of your recognized gains and losses. Because in a given year, you may have a lot heavier load of one than the other. And I always back up here because I don't, there's an old saying that's don't let the tail wag the dog. And I always try to make light of that and say, don't let the tax wag your decisions. Tax advising is very important, but so is financial advising. So you may have a lot of recognized gains already, and you may have some loss leaders sitting out there. So you may go to your tax advisor and find out if there's something that financially it makes sense to sell at a loss to help offset those taxes. But you always want to make sure you're making that decision not just for taxes, but also in a good financial mindset. And the same as the other direction, given 2022 has been a hard year in the financial market, I can say that for my own portfolio, we may have a lot of losses sitting out there. So the conversation may be, do I have any really old gains that I've been holding off on realizing that now is the time because I have these losses to offset tax-wise? So that's something else to think about when you're planning. One other area that really comes to my desk more often than I think it should is gift tax issues. So often a parent will come to me, or a child, an adult child, and dad has put the house in my name, or he's added me to the bank account. And by federal law, that is a gift. If my name is on my bank account and I add my adult daughter's name so that if something happens to me, she can have control of that account, that is gifting her half of what's in that account. Now, the state of Tennessee does not have a gift tax, which is great. But if the gifter lives in another state, you need to be aware of what the gift taxes are in that state. And we all need to be aware that federally, we have gift tax limits. So an individual can gift up to $16,000 in a calendar year without having to pay any gift tax or file a gift tax return. Now, that's not a single gift has to be $16,000. It's all accumulated gifts in that calendar year. So if I gift my daughter a $30,000 car and it's in her name, then that is a gift of over $16,000. The great thing is that I don't have to pay tax on that gift, but I do have to remember that next tax year, that during that filing period, to file a gift tax return. When you file that gift tax return, you can claim your estate tax exemption to offset that gift. And for 2022, the estate tax exemption is $12.06 million. So we can eat away at that a little bit at a time as we make these gifts. But the problem is, if we don't know these rules and we fail to file this gift tax return, it's deemed that we did not claim the exemption, and the federal government can, and I have seen them come back after a person has passed away and say, oh, this gift was made. You didn't inherit that house. That house was gifted to you. They deeded it to you back 5 years ago. And now the estate owes 35% of that value in gift taxes. So that's an important thing to hold on to. And a couple times tonight, I'm going to say before you act, you might want to place that call in to your tax planner or your financial planner if you don't have a tax person, and get some guidance on these things, because so often these things take place because people don't know that there's a gift tax, and don't realize that the person who gives the tax or their estate who ends up paying that if they don't file the return. The second area that I wanted to talk about is some somewhat new information. The main section here, we actually had a question come in before the webinar. The question was, what are the pros and cons of dispersing retirement funds by designated just your estate as a beneficiary versus detailing a custom beneficiary list to your heirs? Whoever you are, that's a very timely question. Prior to 2020, we had long-term rules on inherited IRAs and how you must take distributions on those with required minimum distributions, similar to what you have at age 72. However, in 2020, the law passed and they gave us what we know as the 10-year rule. When that first came out, there wasn't a lot of guidance on that. But we now do have guidance on that. And with that, it helps answer this question, as well as give some information to those of us who have inherited an IRA. So I want to start with the fact that, I'm switching notes here. There are three possible groupings of beneficiaries. The first is your spouse. The second is an individual other than your spouse. And the third is an entity that's not a person, maybe naming your estate as a beneficiary, maybe a charitable organization or a trust. Tax-wise, an estate or most trusts are the least favorable option as a beneficiary. One reason for this is an estate's tax brackets increase very rapidly to the highest 35% bracket, much more rapidly than an individual does. So you're more than likely going to pay more tax on distributing that IRA, that inherited IRA, if it goes to an estate. If it goes to a charity, it has the same distribution rules as an estate, but normally they're not paying tax on that gift, so that's not a concern for them. But the second reason that an estate or most trust is the least tax favorable is this new law. With the 10-year rule, as it's referred to commonly, for an estate, it actually has to come out within 5 years. There's a table that gives us how much based on the value of the IRA, December 31st, the year before, on how much has to come out each year, but the entire amount has to be distributed within 5 years. So that accelerates how fast the tax is paid on these distributions. So tax-wise, naming your estate versus some group of beneficiaries is usually less beneficial tax-wise. The most favorable tax-wise beneficiary to name is your spouse. The spouse is the only beneficiary in an inherited IRA that has the option to make that inherited IRA actually their own. So they don't follow this they have the option not to follow this 10-year rule at all. They can take that inherited IRA and it becomes their own. They also have an option to follow the 10-year rule if that benefits them based on their ages, the spouse's age and the deceased age. So there's a lot more options if your beneficiary is your spouse, and it's a lot more tax favorable most of the time. Finally, the third option is that the beneficiary is an individual, but not your spouse. And if that's the case, then you have to determine, is it an eligible designated beneficiary? Those are IRS terms for certain beneficiaries, or not. An eligible designated beneficiary is someone who is either the owner's spouse, they're the owner's minor child, a disabled individual, a chronically ill individual, or someone who is not more than 10 years younger than the IRA owner. If they meet these qualifications, then there are some special guidelines that may help stretch or decrease how rapid those distributions have to take place. But otherwise, for an individual other than the spouse who's the beneficiary, they fall into that 10-year rule. And there's a table that they have to use to calculate the amount that has to be distributed each year. So I mentioned that this rule actually came out in 2020. And the problem is that they weren't very clear. So a lot of us who inherited an IRA in 2020 or 2021 did not take our distributions. The IRS has told us that they're not going to penalize us on that. So that's the good news, that there's no penalty on that. But we do have to take whatever minimum distribution is required in 2022 or be penalized. So with all of that said, keep in mind that this 10-year rule, these new guidelines, are only for traditional IRAs inherited in 2020 or later. There's no change if you inherited an IRA in 2019 or earlier. And they're also the annual distributions that must take place are only with a traditional IRA. If you have inherited a Roth IRA, you still have to have it all withdrawn by the end of the 10-year period, but you do not have to take those annual distributions. I hope that's more clear than confusing. That's a very, if you do have one of these that you've inherited in 2020 or later, I do know that Steve at Asset Planning does have the table, and my understanding is he has a pretty good understanding of these rules, and they can be helpful with you on that. And then if you have a tax professional, this is something all of us are getting up to speed on this year, because this new guidance just came out a couple months ago, giving us a more clear understanding of these distributions. So hopefully that will help you out, one, in naming who your beneficiaries are in your traditional IRAs, and then also if you have one, in knowing how to proceed without being penalized, because the penalty for not taking your minimum distribution is literally half of the distribution amount. So it's a large penalty. The next section that I wanted to talk about is the Inflation Reduction Act that passed in August of 2022. You may remember there was a lot of news going around about the Build Back Better Act in 2021. That did not pass, but what did pass in August of 2022, the Inflation Reduction Act, has a lot of pieces that were in that Build Back Better Act. Some of them altered a little, some have been removed, some have been added, but it basically came from those original thoughts. And what we thought originally was a big tax bill really has a lot of non-tax items. But there are some tax items that I want to go over that can really be beneficial to some of us going forward. The first one I want to talk about, it regards energy efficient home renovations to your primary residence. So this is the house you live in, you reside in. So it cannot be a rental. It cannot be a business where you have your corporation, you rent for that. And it cannot be a rental. It has to be the home you own. And these are energy efficient home renovations. Some of you may remember, it's been several years, but a law came out allowing us to take a similar tax credit, but we were limited. There was a lifetime limit of a $500 credit. And when this came out, most of us took advantage of that, improving the insulation or some energy efficient windows, or maybe an HVAC system that qualified. And we got that $500 credit within a year or two, and then there was nothing else available to us. The Inflation Reduction Act actually created a 30% of the cost of eligible items as a tax credit, and is a limit of $1,200 per year. So each year that window opens for a new credit. Couple things to note: EnergyStar.gov is a good source for what is covered by this tax credit, the credit percentage that's available, because it does change a little bit per item. The overall credit is 30% of what it costs you to put these energy improvements in place. and the required energy ratings. So, windows and doors and dishwashers, those all have different energy ratings. And if you put things in place that meet these qualifications, then you'll qualify for this tax credit. The other thing I want to point out here is the difference between a deduction and a credit. We've talked about your standard deductions and your itemized deductions. When you're filling out your tax return, you take your total income minus your deductions, and that gives you your taxable income. And from that, you calculate your tax. With a tax credit, that comes into play after that all takes place. After you've calculated your tax, you get to deduct the full credit. So dollar for dollar, a tax credit is going to save you more money than a deduction. So just some of the basics in this. Again, it's a 30% of your cost for the eligible home improvements, up to $1,200 per year for most of these improvements. For example, exterior doors, it's a limited credit of $250 per door each year, a limit of $60 per window and skylights and things like that, electric panels, water boilers. Honestly, I'm going to count it. I'm not sure what a water boiler is, but there's a $60 limit on those. Another interesting piece of this energy efficient home renovations is there's a $150 limit per year on a home energy audit. I don't know if you've seen this, but we have KUB, and a lot of times in that letter they send you with your bill each month, or that you get online, it talks about that you can hire them to do a home energy audit and tell you what areas you need to change. Maybe your windows are drafty, or maybe they can tell with their meter that the insulation isn't very good coming from your garage, and they'll tell you where you can make those improvements to save you money as well as to save energy. And if you do these energy audits, you're eligible for up to $150 tax credit. I thought that was really interesting. There's another section of this that is for some of the larger expenses for the electric or natural gas heat pumps, for the water heaters, biomass stoves and boilers. Those are actually eligible for up to a $2,000 credit each year. Those are the one exception to the $1,200 limit. So EnergyStar.gov is a source for what is covered, the credit percentage, and the required energy rating. And I'm really excited about this because I have so many people come through each year that say, I had to buy I had to put on a new roof and it qualifies for this energy efficient. And I'm like, you met your $500 limit back in 2010, sorry. So we've opened that door back up and have more options there. So I'm really excited about that one. Something else, we've actually had this tax credit for several years. It's actually termed clean energy because these improvements are considered clean energy, not just an improvement on your energy efficiency. So this is specifically for solar electric energy, solar water heating property, fuel cells, geothermal heat pump property, small wind energy property, and the qualified biomass fuel property. I haven't seen a lot of those in my career, but I have had a couple of these on tax returns. And the tax credit is 30% of your cost, but there's not a cap. These are, if you put in a geothermal heat pump property, you're probably looking at, the last one of these was probably a decade ago I did, was maybe $40,000. And you get a 30% tax credit off the bottom, decreasing your tax. That's a great tax credit if you're interested in putting this kind of system in. I told you we've had this for years. It's not new, but what's great is it was set to expire in 2023. The Inflation Reduction Act has extended this all the way to 2032. So we actually have 10 more years for these clean energy improvements to assist us on our taxes. So I was excited about that because that was very quickly about to expire. Something else that's not new, but is changing a lot because of the Inflation Reduction Act is clean, new and used vehicle purchases. More than likely, you've heard that in the past, there's been a credit available for purchasing electric vehicles. In the past, this was limited to the first 200,000 for each manufacturer. So very quickly, those expired. And, it was very difficult to get your hands on these if this was something you're interested in before that manufacturer's tax credit required. The Inflation Reduction Act actually did away with the 200,000 per manufacturer requirement, but put in a lot of new requirements. While it's not going to rapidly expire because of that, it's a lot harder to make sure the vehicle you're purchasing meets the standards. So that the changes actually began in August of 2022 when this act passed. For example, any vehicle purchased in 2022 after August, the final assembly must take place 100% in the United States. And as we go forward, calendar years 2023, 24, and forward, it's not just the final assembly, but the percentage of manufacturing of that vehicle has to be a certain percentage done within the United States. And so while in the past, if it was a Honda electric vehicle and they had not sold their maximum number of cars, you knew that you were going to qualify for that tax credit. With the new standards, it's a vehicle by there may be 5 Honda electric vehicles on the lot, but only one of them qualifies for the tax credit because of where it was assembled or where the parts were manufactured. So this is an area that if you have interest of purchasing these clean vehicles, that you really need to check with your CPA, do some research before you go on the lot, because the IRS has taken it so far as you're going to have to put the VIN number of your vehicle on your tax return so that they can assess and make sure that that vehicle met the standards. So while it's going to open the door to a lot more opportunity for these clean vehicle purchase tax credits, it's going to be a lot harder to make sure that you meet those standards. And the timeline is the date that you contract to purchase the car. Because I know a lot of these are not available. So you're signing today and getting the car 4 months down the road. So you need to make sure that the VIN number, the car you're purchasing, meets those standards for that calendar year to qualify for the tax credit. Something else that's new, beginning in 2023, there's a tax credit not just for purchase of new clean vehicles, but also used clean vehicles. And there's, again, requirements on those. You can't purchase those from a related party. They're going to have to have been a certain amount of time that they've been held before the second purchase to keep people from playing games and just having lots and lots of tax credits on the same vehicle. But it is nice because you're going to be able to purchase some of these electric vehicles used and still qualify for the credit. And that wasn't there before. So that's kind of a summary on the tax items of the Inflation Reduction Act. Before I want to talk about some of the non-tax items, just because they're in the news so much. I feel like you might want some clarification on some of those. Before I do, I wanted to talk about just some inflation items. Some of you may have small businesses where you're reimbursed for mileage, or you deduct mileage on your Schedule C on your tax return. So the IRS sets a standard mileage rate each year. An employer, that's the most they can reimburse. So for January through June of 2022, that was 58.5 cents. Now your employer may only reimburse 50 cents, and they're allowed to do that, but the max they can do is 58.5 cents. Now, if you're self-employed, you're going to take that deduction for the full amount of the standard mileage rate. The difference in 2022 is they've increased that rate halfway through the year. So in the past, where you've given your tax preparer your total mileage for the year, you're going to want to separate that. You're going to give them January through June and then July through December, because July 1, it increased by 4 cents per mile. So it's 58.5 cents January through June and 62.5 cents July through December. Now, if you itemize, the charitable and the medical did not increase for inflation. The charitable is still 14 cents per mile and the medical is 18 cents per mile. Another interesting thing, I'm not sure if any of you are educators, but if you are, we appreciate you. We appreciate our teachers, or maybe you have family members that are. One of the things that's been in the law for a long time, and each year they've just given it back to us. And last year they made it permanent until they voted out that there's a deduction for educator expenses. So if an educator spends $250 or more, that's a tax deduction on their 1040. In 2022, this actually became an inflation item. So they increased that from 250 to $300. So educators get a tax deduction of up to $300 for what they spend to make their classrooms happen. And all the educators I work with say that's a drop in the bucket of what we spend, but we're thankful to get to deduct some of it. So those are some important inflation items that I just wanted to make you aware of. A couple of the non-tax items in the Inflation Reduction Act, most of these have to do, you might have heard that a big part of that, a big push of that act was fair insurance costs or medical costs for Medicare participants. And that's a great thing, because I know there's some issues there, but the problem in what I've seen in the news reporting is it makes us all think it's happening now. So I just wanted to clarify a couple things. If you are on Medicare, or help someone who is, the 35% maximum copay for insulin related medication, that did get passed, and that is effective for 2023. So that's happening just right around the corner. That's one of the few things medical wise that's happening very quickly. One of the other things in the news is that Medicare Part D copays are going to be capped at $2,000. So if you're on Medicare and you've fallen into that donut hole, or the prescription copays have been an issue, this is great news for you. So that those Part D copays are capped at $2,000, but this isn't effective until 2025. So that's not something you're going to see right off starting in 2023. Additionally, also big in the news are that there's going to be some medications that have Medicare negotiated prices. And that's true, that did pass. But what's going to happen is they've told us in the Inflation Reduction Act that for 2026, there'll be 10 medications that have negotiated drug prices. And then in 2029, 3 years later, there'll be 20 more drugs. They're saying it's going to take them that much time to come to agreement on which drugs and what those negotiated prices are. So we're not going to see any of that till 2026. Look, there'll be 10 drugs, we don't know what they are, that will have negotiated prices for Medicare participants in 2026, and an additional 20 medications in 2029. That's the big things that are going to impact. There's a lot of other things in the act that affect corporations and some higher dollar business issues, but those are the things that impact most people. Before I moved on, there were a couple other questions I wanted to make sure I had time for. One was, can you provide us with a checklist approach to ensure we're doing everything reasonable and needed for a tax season? And I always kind of laugh at this question because, you know, we've talked for years and years in tax legislation that we want a simplified tax return, or we got that postcard tax return a few years ago. It didn't really simplify things. It just rearranged things on the return. But if we had that simplified tax return, there would be a simple and easy checklist. But since, you know, of the returns that my firm does, very few are very similar, I've always told my clients that the best checklist to start with is to look at your previous year return. So, you know, when I look back at my checklist, I look at last year's return and make sure that I have similar W-2s if I had similar jobs, that you know, your 1099-Rs come from your IRA distributions and your pension distributions. A lot of times those don't change. Or maybe you started a distribution from a new, or you rolled an IRA to a different location, so you have a different 1099-R. Those are the things on your checklist. You look at last year's and say, okay, you know, I've started taking my minimum distribution, so I should have a 1099 from Schwab. You know, these different locations. Interest and dividends for investors. If you're a client of asset planning, I'm guessing you're a saver and an investor, and you're probably going to have some 1099 interest and dividends come in, and then also some consolidated 1099. So your 1099 interest and dividends are going to come from your banks, or maybe you have some stock investments with some individual stock accounts, like you'll get a 1099 dividend from from that one company. Maybe you have stock in the bank you used to work for. You'll get that 1099 dividend from that organization. If you have investments at Schwab that are after tax, your brokerage accounts, you're going to get a 1099 consolidated from them. So however many investment houses or how many brokerage accounts, if you have 3 brokerage accounts, then you should get 3 1099 consolidated statements. And you can contact your advisor and say, I just want to check and see if I'm getting anything from you, because what throws a lot of people off is their W-2s and their 1099s, their Social Security statements, their interest and dividends. Those all have a deadline to be postmarked by the preparer by January 31st. But your consolidated 1099s from institutions like Schwab actually have till February 28th to send those out. And a lot of times they come out later with corrections because there are so many required year-end adjustments. It's not that anybody enjoys holding us up during our tax returns, but they have year-end adjustments within those investments that have to be made for your form to be correct. So they actually have to February 28th to postmark those. And then if you have a business investment in a partnership or an S corporation, you're going to get a K1 from their tax return, and they actually have until their filing deadline. So the IRS actually made some changes 2 years ago that made probably one of the most sense that I've ever seen. And the tax law change is that those organizations are now due on March 15th, where yours is due on April the 15th. So unless they extend, you should get yours in plenty of time to prepare your return. So that's part of that checklist. And then additionally, if you're not taking that standard deduction, and for 2022, the standard deduction is $25,900 for married and filing joint. For head of household, meaning you're single but have a tax dependent, it's $19,400. Or for single filers, it's $12,950. So if you're close to that, or you're thinking you're going to be able to itemize, you're going to gather the information on those. So that's all your mortgage interest statements, real estate taxes, state income taxes if you pay those. Now I know Tennessee doesn't have a state income tax. Our hall tax expired in 2021. We're all very excited about that. But if you live in Tennessee, a lot of my clients work in Kentucky or Virginia, so they're still filing an out-of-state return and have a state income tax. You get to deduct either state income tax or the sales tax, whichever is higher. And then for most of us in Tennessee, it's our sales tax. And with that, we have 2 choices on how to calculate that. The tax instructions have a table based on your adjusted gross income. And so that tells you, this is what we think your sales tax would be. You can take that number plus any actual sales tax paid for a motor vehicle or a boat that's registered. So if you purchase a 4-wheeler or a golf cart that's not roadworthy and you don't register, that doesn't qualify. But anything that you have to register does qualify. And you can take that table from the sales tax plus the actual sales tax paid for those boats and motor vehicles. And that's that deductible amount. Or some of my clients actually keep up with their sales tax throughout the year, and you can do your actual sales tax. You cannot take the table plus big sales tax items, except for that boat and vehicle, but you can keep up with everything. Usually the table is a better option. I do have a handful of clients, one for a couple years where they were doing major home expansion. And so they had a lot of building supplies, that sales tax on those, and that made their actual higher. And a couple others, it's just their spending. They know that they have a little bit higher spending on sales taxable items than average, and so they're able to take the actual sales tax, and that's beneficial to them. Another itemized deduction is your charitable giving, cash and non-cash. If you give to Carm or Goodwill, make sure you get a tax notice, and your charitable mileage at 14 cents per mile. Something that a lot of charities don't actually do accurately, and you want to make sure, if you think you're itemizing, if you give $250 or more to an organization, you're required by the IRS prior to filing your tax return to have acknowledgement from them that you gave this gift, and the statement that no goods or benefits were received in exchange for your gift has to be on the statement. So some of the smaller, even 501c3s, don't realize that they have to put that language on there. So if you're choosing to itemize, you want to make sure that that language is on your acknowledgement. And there's actually been tax law cases lost when the taxpayer did not have that acknowledgement prior to filing their return. And that just seems odd because they did make the gift. It was very clear that they made the gift, but the IRS can deny, and they have, that charitable gift if you did not have that letter of acknowledgement prior to filing your tax return. Less common itemized deductions are investment interest, but that is an itemized deduction. And then, of course, the medical deductions. To deduct medical expenses as an itemized deduction, you can only deduct those over and above 7.5% of your adjusted gross income. That's the reason I say it happens very rarely. I tell my clients it's either a very bad medical year or a very bad income year to be able to deduct your medical expenses. But if you're getting there, that's your insurance premiums, long-term care premiums, copays, deductibles, medical mileage at 18.5 cents per mile, medical equipment such as hearing aids, glasses, contacts, travel and meals for out-of-town treatments. A lot of people don't realize that that is a deductible medical expense. Those are out-of-town travel expenses for the taxpayer as well as one caregiver. Now, those are limited. There's a certain number of days that you can deduct and a certain maximum amount per day. But if you're looking at being able to deduct medical, you definitely want to include that as well. So that's a big checklist. But basically, I say you look at last year's return and what I know changed this year. A lot of people with the housing market have sold their home. You need to remember that the tax law changed several years ago on this, but a lot of people still remember the old tax law. Old tax law was that if you sold your home and reinvested that gain within a year, you didn't have to pay tax on it. Now, that expired a long time ago. The new tax law is if you sell your primary residence and it has been your primary residence for at least 2 of the last 5 years, and you've not taken this exclusion within the last 2 years, then you can exclude up to $250,000 of gain on that sale of your primary house. You don't have to put it back into a new residence. This is great for older people that are going from a home they've been in for a long time to maybe senior living. So because you're paying less for that, it's a smaller investment up front. So that's something that's really important to keep up with. So say in 1950, you bought your home for $100,000, and this year you're selling it for $600,000. Pick an easy math. And you're a husband and wife. So the husband can exclude that. You've got a $500,000 gain there. The husband can exclude $250,000. The wife can exclude $250,000. So there's no tax paid on that. So the sale of your primary residence that you've lived there 2 of the last 5 years. Now, if you've rented it or used part of it in a business and deducted that part within that business, that complicates the math, and some of it will be taxable. But the overall tax law is very taxpayer friendly. Second question, another question. I still don't have my 2021 tax return. Is there anything I should be doing to help prepare myself for the coming tax season? You don't know, you probably don't realize how much in the majority you are. What we've seen in the past couple of years, we use COVID for excuse for a lot of things, but it's actually very valid here. Most of our employees with the IRS have been there a long time. There's a very senior part of that employment. And due to the deaths and employees taking early retirement during COVID, IRS is still very behind on processing any returns that require an individual to process that return. They have hired additional staff, but it's taking a lot of time to get that new staff up to speed and functioning as well as those that they've had for such a long time. It's been sad, but almost humorous on the other end of the phone call, listening to some of these newer agents try to work through how to resolve some issues I've had. But what we've seen is, the good news is, if you file your return electronically and there's no odd issues that require an employee to actually process it or review it, then the turnaround time is still a few weeks or less. However, if you file a paper return, or if you have to file an amended return, an agent has to process every amended return. Another reason an agent would have to process if one of the taxpayer is deceased, and is part of filing that tax return. Those are returns that absolutely have to have an agent process them, amongst some other things. And if you have that, we're just going to experience some long delays. I actually have 4 of my clients from 2019 that have not gotten their tax returns yet, their refunds back. And sadly, when I call to check on the status, I very rarely get a live person. So they're still trying to catch up. And if you do talk to somebody at the IRS, I try to be very nice because they're trying. I really do believe they are. They're just very behind, and it's painful because I want to take care of my clients. I want their refunds to come. But the good news is for you who hasn't gotten your 2021 process yet, what I've seen is if there's a problem with the prior year, it is not affecting future years. So my clients with problems with 2020 or 2019, their 2020 and 2021 returns went through without any problem. So it's not delaying future years. I do recommend, though, if you have a delayed previous year filing with an overpayment, I recommend not counting on that overpayment to be applied as a payment to your current year return. The problem with that is IRS is still working on 2021. They haven't resolved it, so they haven't pushed the button that applies that overpayment to 2022. You, in the meantime, file 2022 and you say, well, I've applied this $2,000. Well, the IRS says, I don't see that. And so then it has to be processed by a person. So now you have a delay on 2022. So I do not recommend taking an overpayment on a previous year that you know has a delay and applying it to a current return. So that it's a sad situation, but it really is just where they are, and hopefully they're working their way out of it. I have not seen any improvement myself, but hopefully they're getting there. I have seen some returns come through, just not all of them. Finally, overall, not a disclaimer, but just advice. This is really some general information. I strongly suggest before you take any action on anything I've said, anything you've seen on TV, anything you've read, that you consult your tax advisor, because everything is specific to your circumstances. So I strongly suggest you talk to your tax advisor and make sure it fits your tax plan. I know Joe has some things he plans to add, but I hope this has been beneficial. This has been the strangest thing I've ever done, is to listen to myself talk for this long and not even see a reaction. I've taught classes, but I've always been able to see faces. But if you have questions, I know we probably won't have time tonight, but asset planning will work hard to answer those for you. And again, thank you for your time.
Sarah, that was fantastic. What a wealth of knowledge, and providing very practical insight into the tax code and some things that I've written down to follow up on. So appreciate all the homework you did to prepare for this. I would say a couple things. One being that we are experiencing a bear market this year. It does happen from time to time, but asset planning and the team at asset planning is not twiddling their thumbs, feeling bad for ourselves and our clients. We are actually tax loss harvesting. And that means we are taking full advantage of the IRS code that allows for harvesting losses without abandoning your investment strategy. So you're going to see a final round of rebalancing and tax loss harvesting in the next 2 or 3 weeks. And Steve is getting geared up for that, which is one of the highlights of his year for sure. So we're excited about that. And one thing I did want to share, Sarah did talk about bunching, which we talk about in our client meetings, as you know, and we are a charitably minded firm, as are our clients. And James, if you don't mind sharing that one slide. And this has to do with gifting, and want to make you aware that there are limitations, though. So, for example, if you want to give cash this year, and that may be the most effective strategy for you, it is limited by the IRS to 60% of your adjusted gross income. Whereas if you want to gift securities, that is stocks, mutual funds, and the like, that's limited to 30%. And I know if I'm misspeaking in any way, Sarah will correct me, and I trust she will do that. But I wanted to just make you aware of that there are limitations. You should check with your tax professional as to what is the best strategy for you. And we can also provide some guidelines around that as well.